I have always been pretty proud to call myself an investor because I have been holding a few altcoins here and there. Every now and then, I open the app just to admire the prices. When the market is green, even the way I walk starts looking a little more like somebody who really knows finance. Sometimes when I am chatting with friends, I casually slip in a few lines about how I am investing in crypto, analyzing the market, watching money flow trends, and all that. It sounds pretty impressive too. Then one day, this tactless friend of mine said, "Investing in what? That crypto stuff is basically just gambling." I was ridiculously offended when I heard that. I almost wanted to smack him for saying it. But when I sat down and really thought about it, I realized he was not exactly wrong. At first I used to think, well, it kind of looks like stocks. You buy in and hope someone else will buy it from you later at a higher price. But once you really put the two side by side, they are completely different. Stocks are the old school traditional product. That stuff is ancient. Now it is all about blockchain, decentralized technology, the currency of the future. But hold on a second. When you buy a stock, at least there is something real underneath it. It represents part of a business with revenue, profit, assets, and an actual operation. If the company is doing well, it makes sense for the price to rise. And if a company is going bankrupt, there has to be a real reason for it, and it has to go through legal oversight. When you buy real estate, even if the price goes up or down, it is still a usable asset. You can live in it, sell it, rent it out, or at the very least, it still has a pretty obvious real-world value. But when you look at most of the crypto market, especially altcoins and meme coins, a lot of them do not actually produce cash flow or any real product at all. Their value mostly comes from the greater fool theory, meaning you buy it only because you hope there will be someone even more foolish willing to buy it from you later at a higher price. That is really not much different from betting on a random outcome. There is nothing solid to hold on to, and there is no asset backing it up. What is worth noting is that in this market, belief does not just appear naturally. Most of the time, it is carefully manufactured to lure in the crowd. A classic example is the pump and dump setup, where a project gets hyped up across social media, influencers, and online communities, making people think they are about to catch the opportunity of a lifetime, and then the insiders dump on the people who came in late and bought the top. At that point, it is basically a game where money is mostly moving from the latecomers' pockets into the early players' pockets. And that is not even the end of it. With smaller coins that have thin liquidity, whales can absolutely push the price up, or slam it down on their own, just to fleece retail traders. Newcomers look at it and think, the trend is real, like some huge opportunity is on the way, but a lot of the time it is just a big player setting a trap and waiting for people to jump in on their own. If this happened in the stock market, regulators would call it market manipulation. But in crypto, there is barely any oversight, so manipulation becomes much easier. And if you still do not think that sounds much like gambling, then look at derivatives trading, like futures. At that point, investor is not even the right word anymore. Player is more accurate. In that game, people almost stop caring what coin they are trading, whether it creates any value, or whether it has any real use at all. The only thing they care about is this. Will the price go up or down in the next few minutes? Guess the direction right, you make money. Guess wrong, you lose money. And somehow that still gets called investing. Personally, I think better would be a more honest label. Real investing takes time for an asset to create value. But here, everything depends on predicting short-term price movement, and your account can turn green or red almost instantly. And when leverage gets involved, it becomes even crazier. At that point, people are no longer playing 1-to-1. It becomes 1-to-10 or even 1-to-100. If you guess right, the money moves fast and the rush feels incredible. But if you guess wrong, even a tiny move against your position can wipe your account out. What makes it even more twisted is that in this game, you do not really know who is sitting at the table with you. If it were just traders against other traders, that would still be bad enough, but at least it would be somewhat fair. But the real problem is that sometimes the person sitting across from you is the house itself, meaning the exchange operator. And when that happens, it is like playing cards face up while your opponent can see everything you have got. That is right. In this market, there are usually two operating models. With a book, the exchange mostly acts as a middleman. User orders get routed outward or matched with other traders. In that setup, the exchange makes money from trading fees and bid-ask spreads. Whether you win or lose, the exchange still gets paid, so it wants you to stay alive and keep trading. At least in theory, that model is more fair. But with B-Book, the story is completely different. In that model, the exchange is not just a middleman anymore. It is also taking the other side of your trade. When you buy, it sells. When you sell, it buys. And once that happens, your loss becomes its profit. At that point, fairness starts disappearing. In futures trading, people usually place stop-loss orders, meaning they set a price level in advance so that if the market moves too far against them, the position gets cut and they limit the damage. It sounds disciplined, it sounds civilized, but the problem is that the exchange can see every one of those levels. And if the exchange is playing dirty, it can absolutely use that data to see where the crowd has stacked up its stop-loss orders. Once it spots an area packed with orders, all it has to do is create a quick wick that barely stabs through that zone. Suddenly, a whole bunch of stop-losses get triggered, and anyone using high leverage can get liquidated on the spot. After the crowd gets wiped out, the price snaps right back to where it was, and it still looks like it is following the same overall trend as every other exchange. But in reality, a lot of people have already been kicked out of their positions and had their accounts blown up for no good reason. The bigger trend barely changed. The only thing that disappeared was the money in their accounts. Yeah, right, more exaggeration. What exchange would ever dare do something like that? Actually, there is. Just look at the recent ONUS case. Is that not one of the clearest examples? To this day, the ONUS exchange has millions of accounts. In order to manipulate the value of virtual coins listed on the ONUS exchange, the people involved interfered by creating fake buy and sell orders, causing investors to lose money. Prices would be pushed up or down depending on whether users were buying or selling. The person directly adjusting that price ratio was Mr. Chien. And I seriously doubt ONUS is the only one. There are probably other exchanges operating in a similar way too, and ordinary traders like us would have no way to see it from the outside. Even Binance, the biggest crypto exchange in the world, has been sued and fined by the United States Securities and Exchange Commission and the United States Commodity Futures Trading Commission over a range of legal issues, including derivatives. Now, whether there was any direct candle price manipulation, I honestly do not know, so I'm not going to claim that. That is why I personally do not trade futures. I have tried it before just to know what it was like. Once I understood it, that was enough for me. It just feels way too risky and a lot more like gambling than investing. And by the way, futures are not just a crypto thing. You have them in the stock market and in foreign exchange too. The basic nature of it is the same. As for crypto in general, yes, I still participate in it. But I go into it fully aware that this is a high-risk market, extremely volatile, and easily driven by belief and crowd psychology. Still, if you are only buying and selling normally, at least the game is less distorted than futures. The price can drop hard, but if the market comes back, there is still a chance to recover your capital or even make a profit. That does not mean you are investing in the purest sense of the word, the way many people like to imagine. Because at the end of the day, in most of this market, even with Bitcoin, the price is still based mainly on belief and on the expectation that someone else will buy it later at an even higher price. So the nature of the game is still the same. The only difference is that the gambling aspect has not been amplified as brutally as it is in futures. So if you are going to step into this market, the first thing you should not do is dream about getting rich fast. The first thing you need to do is understand exactly what it really is. Understand that this is not some easy gold mine. Understand that the more obsessed you are with leverage, and the more desperate you are for quick wins, the easier it is to turn from an investor into a gambler without even realizing it. And understand that in a market powered by belief like crypto, making money is hard, but keeping it is even harder. I hope you all invest smart.